Please. Hi, we're on a tight schedule because we have important people here, not least of whom is each of you. And we're about to start internationally, online. Are we ready to roll? Okay. Hello, everyone, and welcome back for the 19th time this week to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president. It's a particular source of pride for us today. We see many distinguished and old friends in the audience, even some distinguished new friends. To have today a cross-country, cross-sector, forward-looking discussion of a vision of the future financial system. We are grateful to Agustín Carstens, the general manager of the Bank for International Settlements, who called me up and said, "Would you like to host this?" And I said, "Oh, yeah." And then he said, "Well, we're going to bring in Nandan Nilekani." I said, "Oh, yeah, that's good too." And he said, "I'm going to bring a few friends of mine from central banks." I said, "Bonus." Joking aside, the fact that there are, I believe, 3 sitting central bank governors here, along with the general manager of the BIS, along with Mr. Nilekani, to talk about this says that we are moving beyond the stage of talk. That for all the discussions of fintech and how this is going to really help the world and really help people, and has been a recurring theme of meetings after meetings after meetings, we're now finally getting to see it. And so with that in mind, I am eager to introduce our first 2 speakers, who are Agustín Carstens and Nandan Nilekani, both of whom need little introduction. And then we will have a panel discussion with those 2, with Joachim Nagel, Changyong Rhee, and Roberto Campos Neto. So Agustín Carstens has inherited, in my view, the role that Stan Fisher used to play, which is to be the dean of central banking in the world. Agustín, of course, was the governor of the Bank of Mexico from 2010 to 2017, and he has been in charge of the Bank for International Settlements since then. He is energetic, creative, tireless, unafraid to have very brilliant people like Hyun Shin working for him, and a leader. And he will be followed by Nandan Nilekani, who is the co-founder and chairman of Infosys Technologies Limited. And for those of us who care about the public sector and the global good, he was the founding chairman of the Unique Identification Authority of India, UIDAI, as a cabinet minister rank from 2009 to 14. He is currently the co-founder and is chair of the EK STEP Foundation, a not-for-profit effort to create a technology-based platform to improve literacy and numeracy for millions of people. I'm not going to go through all his distinguished business career, but just to say the creation of the unique identifier in India was a huge leap forward for hundreds of millions of people, and we're all in your debt. So with that, at 3:04, let me turn to Agustín for some remarks. Thank you.
Well, good afternoon, all of you. I would like to thank the Peterson Institute and my good friend Adam Posen for hosting us today. It's a real pleasure to be in this room. I have, in my different categories, given him many speeches, been in many events, and really the Peterson Institute is a jewel in Washington and in the world, because it really allows us to discuss interesting and important things. And of course, I'm delighted to be joined by Nandan Nilekani, my collaborator in this endeavor. And I look forward as well to hearing from Roberto Campos Neto, Joachim Nagel, and Changyong Rhee, 3 central bank governors whose institutions are pushing the boundaries in the use of technology to drive financial innovation. Today, Nandan and I are proud to present our new report, Finternet, the Financial System for the future. This is the result of more than a year's worth of discussions and thinking since we first met to brainstorm the concept on the sidelines of the G20 meeting in Bengaluru in February last year. For the BIS, this is another stage in our exploration of how advanced technology could deliver a more innovative and efficient financial system. I am encouraged by our work in this area. We have learned many valuable lessons and drawn some striking analytical insights. But at the end of the day, we at the BIS are mostly economists and finance specialists. To really understand how to apply technology, we need to bring technologists fully into the conversation. That is what Nandan and I have sought to do. We aim to bring together the economic and financial perspectives of me and my colleagues at the BIS with the technological know-how of Nandan and his team. And in doing so, to articulate a vision for the future financial system that unites a robust economic and financial foundation with state-of-the-art technology. In particular, we sought to sketch a blueprint of the economic and technological architecture for a future financial system and show how we could turn it into reality. Nandan and I come from different worlds. I wouldn't go so far as to say that economists and technologists speak different languages, but we have our own distinct dialects. At times there was dissonance in views and perspectives. This is healthy. If we don't start the dialogue between economists and technologists, it is hard to see how useful financial innovation can really move forward. We have labeled our vision for the future financial system the Finternet. I will leave it to Nandan to expand on it and explain the more technical aspects. But let me provide a broad overview. The Finternet is a vision of multiple financial ecosystems that connect with each other, much like the Internet. It aims to empower individuals and businesses by placing them at the center of their financial lives. The application of technology has meant that tasks that were once expensive and time-consuming, like making an overseas phone call or booking an hotel room in an unfamiliar city, can now be done with the flick of a finger. The Finternet aims to bring the same kind of progress to financial services. We foresee a system in which individuals and businesses could transfer any financial assets they like in any amount at any time using any device to anyone else anywhere in the world. Financial transactions would be cheap, secure, and near instantaneous, and they would be available to anyone. This is particularly important for emerging and developing economies. Despite many noteworthy initiatives to bolster financial inclusion, spearheaded by sovereign authorities, central banks, multilateral financial organizations, including and even the United Nations, large gaps in access to financial services between advanced economies on the one hand and emerging market economies and LDCs on the other still exist. As you walk down the line of the complexity of financial transactions and instruments, it is striking how many activities are just not available in many of these countries, particularly to those living in remote areas or at the bottom of the income distribution. And even when residents can access financial services, high transaction costs and slow services are pervasive. These reflect a number of structural deficiencies, including a lack of competition, inadequate public infrastructure, and bottlenecks induced by legacy systems that have not kept pace with the capacity needs of a modern economy. Our starting point was the observation that recent years have seen a flowering of innovation in financial technology. This has led to some important breakthroughs. Programmable ledgers are one example. These digital platforms combine the record-keeping functions of traditional databases used to track the ownership of financial assets with the rules and governance arrangements needed to update the databases. These ledgers enable smart contracts, self-executing applications that can trigger an action, for example, the sale of an asset if a pre-specified condition is met, and composability, the ability to bundle many of these automated transactions together. Tokenization is another example. Tokens are the digital assets that exist on programmable ledgers. They contain both the information necessary to uniquely identify the assets and their owners, and the rules and logic governing their use. And more advances could soon arrive. I am particularly encouraged by the transformative potential of artificial intelligence for the financial sector. The BIS will have more to say on this when we release our annual economic report in June. As we reflected on these developments, Nandan and I were both struck by the focus of innovation efforts on very specific and narrow technologies, financial assets, and use cases. Surprisingly little thought has been given to how technological innovations could fit together. This matters because the real value of many of these technologies and applications will come when they are combined into a seamless, interconnected network. To take one example, tokenized assets could drastically lower the reliance on lengthy messaging, clearing, and settlement processes that are the cause of so many costs and delays in today's financial system. But they will only do so if different asset tokens, including tokenized forms of money, exist on the same digital ledger, or at least ledgers that can seamlessly interact with one another. Similar network effects apply to many of the other financial innovations. As an analogy, I think you will all agree that cell phones are much more useful than they were a decade or two ago. This is because of advances in all aspects of phone technology, in the handsets, in the quality of apps, and in the shift from 3G to 5G networks. The combination of these advances is worth much more than the sum of their parts. A 5G network would be of little use if we still had the same phones as at the turn of the century, and smartphones would be wasted if we could only use them to make phone calls and send SMS messages. The principle behind the Finternet is similar. To really unlock the value of financial innovation, we need to bring all these pieces together. And it is important to do so now when the technology is mature enough to use, but before we get locked into rigid institutional frameworks or walled gardens erected by large financial institutions or by big tech companies. We have a once-in-a-lifetime opportunity to revisit the architecture of the financial system. Instead of asking what financial technologies will we use in the future, we should ask what will be the entire future financial system look like. And we should figure out the requirements to allow us to make the quantum leap to get there. So what do Nandan and I propose? The application of more advanced technology is necessary, but the technology is not an end in itself. Its value come when it is applied alongside robust economic and financial architectures and trusted institutions. The core idea behind our approach is to have a financial system that relies on the exchange of tokens in the context of unified ledgers. Intermediaries would facilitate the trades, the onboarding, the offboarding, and the tokenization of assets. The management of tokens would be done by different intermediaries and ledger owners that will be a part of the system. Key procedures will be the authentication of the parties who is trading, the verification of ownership, who has what, and the off and on ramps, as they are key for the integration of the system to the rest of the economy. In short, tokens and unified ledgers based on programmable platforms enable a shift in how financial transactions would be conducted. This will require a number of building blocks. We see unified ledgers, programmable platforms that bring together all of the financial assets needed to complete the financial transaction as an important vehicle to deliver the Finternet. Equipped with tokenized assets, these ledgers would drastically reduce the need for lengthy messaging, clearing, and settlement systems. They would enable programmable transactions and greatly simplify compliance processes. They would meet and perhaps exceed the regulatory and supervisory standards that are required in today's financial system. In doing so, they would unlock the power of tokenization, offering users faster speed, lower costs, and more reliable service. To be clear, we are not advocating for one ledger to rule them all, a single ledger that encompasses all financial assets and transactions in an economy. Depending on the needs of each jurisdiction, multiple ledgers could coexist. They would need to connect with each other and with other parts of the financial system, for example, through application programming interfaces. And their function and the range of assets they contain would likely evolve over time. They might start with a small number of assets and use cases before gradually expanding into something more ambitious. A two-tier monetary system, similar to the one we have today, will be another important building block. Central bank money will represent the first tier and commercial bank money the second. Settlement on the central bank balance sheet is the ultimate guarantee of finality in financial transactions. As such, wholesale tokenized central bank money is a necessary foundation piece. It will play a similar role to reserves in today's financial system, but offer enhanced functionality. Tokenized deposits will provide a natural retail counterpart to tokenized central bank money. As in today's financial system, commercial bank money will serve as the primary means of payment for most individual arrangements and businesses. In passing, let me mention the last week we at the BIS launched Project Agora in collaboration with 7 leading central banks and multiple financial institutions gathered by the IIF, and I thank Tim Adams for his efforts. This project will investigate how tokenized commercial bank deposits can be seamlessly integrated with tokenized wholesale central bank money in a public-private programmable financial market infrastructure with a specific application to cross-border payments. A robust regulatory and supervisory structure will be a third building block for the Finternet. It will preserve the institutional arrangements, including deposit insurance, settlement of central bank balance sheets, and prudential regulation that ensure today's the singleness of money and trust in the financial system more broadly. And it will ensure that the Finternet does not provide a venue to circumvent laws or to engage in regulatory arbitrage. Meanwhile, the use of technology in supervision and regulation could lower compliance costs while delivering stricter adherence to rules and regulations. In the Finternet, existing financial services will still exist, but be more efficient. And the combination of robust economics, innovative technology, and strong governance will create space for new innovative financial products to emerge. In the economics jargon, markets will be more complete. Meanwhile, by lowering costs and creating new venues for financial activities to take place, the Finternet will lower the barriers that still keep far too many people locked out of the formal financial services. The gains could be particularly large for emerging markets and developing economies. So how can we make the Finternet a reality? A first step is to clear the impediments that currently stand in the way. Laws and regulations that restrict the deployment of new technologies are one example. The ambiguities that still exist in many jurisdictions about the treatment of tokenized assets and other innovative financial products deserve urgent resolution. A second step is for both the public and private sector to play a part. Public authorities have an important role to play. Through the development of digital public infrastructure, they can establish the platforms, rulebooks, and regulatory protections required to deliver an open and efficient financial system. And as suppliers of central bank money, they will continue to provide the foundational asset for the entire monetary and financial system. But public authorities cannot and should not be the main providers of digitally advanced financial services. That is the private sector's role. They will both need to collaborate to realize our vision of the Finternet. Finally, there is an urgent need to experiment to learn more about how innovative technologies like tokenized assets and unified ledgers can be deployed in the real world. At the BIS, we're doing our part, not least through our innovation hubs. There, in conjunction with our partner central banks, we're pushing the envelope of exploring what is possible with innovative financial technologies. There is plenty of space for others to join in. I truly believe that now is the time for a Neil Armstrong moment, that small first step that represents a giant leap for the financial system. We know where we need to go. We have the tools to get there. Now it's time to take the first steps. Let me now hand over the floor to Nandan, who will tell us how this vision could be landed in real life. Thank you very much.
Thank you, Agustín, and for setting the stage for this. I'll try to keep it as non-technical as possible. Also, thank you, Adam, for hosting us. And Adam, of course, didn't mention that I also served on the board of Peterson many moons back.
You're welcome to come back.
So I'll just walk you through the idea of the Finternet, the financial internet, and later on I'll explain why we think of it as the financial internet, which we think is really about empowering individuals and businesses at the center of the financial life. Now, just to set a few things, in India, for example, India was the most unbanked country, and we managed to accelerate banking penetration and did financial inclusion in 9 years, what would have taken 47 years by traditional means. Built a KYC system that does 16 billion transactions to open bank accounts and mobile phones, brought down the costs. Today, 250 million people have their digital records in their phones, in their lockers. We have a payment system which does 13 billion transactions a month, and Roberto has done a fantastic job in Brazil with PIIE, which has also transformed Brazilian payments. And we have always thought about technology as requiring it to be universal. That is, in other words, technology should be for people, rich people who have smartphones, people who have feature phones, people who don't have phones. So everything we do should be done with universality in mind. So that's been the broad thinking that we've had historically. And we have seen, whether it's in India or Brazil or anywhere else, that if there's strong regulatory push, if there is political will, if there's the right technology, we can make things happen. So it's with that background of having been participating in making things happen that we have done this paper. So this paper is not just a theoretical paper, it's actually a plan of action, a call for action, and we look forward to working with all of you on that. Now, what is it about the financial internet? What are we trying to do? First, we are trying to think of a financial system which puts the user at the center of it. In other words, whether it's an individual or a business, whether it's retail or wholesale, the financial system should be designed with the user in mind. And often that doesn't happen. Second, we want to create a unified approach to the financial system. In other words, this should work in all countries. This should work in all sectors. This should work for all asset classes. It could be bonds, it could be cash, it could be shares, it could be mutual funds, ETFs, gold. I don't know if I can say this in front of central bankers, it could be Bitcoin. Anyway, so the point is that it is essentially neutral or agnostic to the asset classes. It can also be done over time. This is not a big bang approach where we get up in the morning when we are in this beautiful new world. This could take years to roll out. Different countries, based on their appetite for change, will do it differently. Different sectors will do it differently. The design that we have proposed is completely asynchronous, which allows different people to come onto this thinking at different times, which is the way it should be. And maybe over a few years, it'll all happen. And a lot of focus is how do we design from the beginning to reduce loss, fraud, and actions of bad actors, which is a common phenomenon today in the financial sector. Now, this is also meant for different kinds of asset. They could be assets that users have their entire control over, which are bilateral transactions between two buyers and sellers, where there's no regulation or there's no other, you're buying and selling something that you have, like an NFT or something, or a personal car or something like that. Then you have assets that are attested by different kinds of attestations, verifiers, guarantors, and so on. Then you have registered assets, assets like cars that are registered in the vehicles database, or land, which is a land titling database. And then finally, you have regulated assets. This could be money, securities, and so on. The architecture we are proposing covers all these types of assets, whether they are user assets that are bilateral OTC kind of assets, or whether they are highly regulated assets. So the same architecture is for all of them. Now this, if there's one slide I want you to think about is this slide. I know it looks a little forbidding and intimidating, but this slide captures the essence of what we are doing. And if you really want to take this forward, I would request you take a copy of this and put it on a pillow, and you'll absorb what is going on here. I'll speak from here. So what are we showing here? What we're showing here is how does this approach of tokenization fit into the real world? In the real world, we have all kinds of players. We have central banks, commercial banks. Can you hear me?
Thank you.
Central banks, commercial banks, and so on. You have different kind of value-added players who help you to, like people who give you land titling or people who give you insurance and so on. You have users and you have applications. Now, all this is already in the real world. You have these institutions, you have these other guys who do verification, you have new kinds of applications. And then you have existing infrastructure, which is either digital in nature, which provides identity or signatures and so on, as well as all the laws and regulations that govern us. So all this is already there. But we have an inefficient system which is slow, which is costly, which excludes people. So what we have done is essentially airdropped. Like that Apple phone does airdrop. We have airdropped a high-performance token-based transaction engine in the middle of this. So it's a very elegant, minimal way of doing transformation, which is you keep all this stuff, but insert this little thing in the middle. It's like taking an old car and putting a new racing engine in it. Let's think about it like that. That's what we're doing here. Now, what is that? What is that engine? That engine is what Agustín talked about, is a ledger. And ledgers and other technologies have enabled us to become more efficient and make immutable transactions, and a number of technical benefits of ledgers. We have done that, but as Augustine mentioned, we don't want it to be only one ledger. This is not Lord of the Rings. This is about having multiple ledgers with multiple providers. So the architecture provides for that. It also keeps a ledger of all kinds of assets, whether it's equities, deposits, real estate, bank money, whatever it is. So you have multiple ledgers, each of which can keep multiple types of tokenized assets. And these ledgers are maintained as accounts for users. This is where the user centricity comes. So the user opens an account in a ledger of his choice. It's no different from me opening an email account with Gmail or Hotmail or Yahoo. And I keep my different assets tokenized in my account in my ledger. So far, so good? Now, what happens is, if I am a user, I can take a deposit from the bank, or I can take a mutual fund or an ETF from my asset management company and ask them to tokenize it and give it to me. And then I will keep it in my account. And my account will have a mix of assets. What this does is essentially unlocks the closed system here and creates a marketable set of tokens which can then be traded among themselves. And it's possible that I have two users who are on two different ledgers. We can just sell to each other, transfer the asset to each other, similar to me sending an email from my Gmail account to your Hotmail account. And this will then essentially create this real-time, high-performance engine for transactions, but without changing any of the rules of society. And that's the power of this, that we are using the value of cryptography, the value of real-time transactions, 24/7 operations, all that, but within a regulatory framework which allows all the laws to be enabled. Now, how do you build applications? The applications will be built by various providers, companies, banks, whoever it is. So that is where the innovation will come. So any innovator can build an application at that layer for any user and use this infrastructure. So this will lead to an explosion of innovation as different actors, market actors, regulated, unregulated players, all deliver applications for different users. So you're creating a market on top of an existing system by inserting a high-performance, tokenized-based transaction engine in the middle of it. I mean, that's simplistically what it is. And this is our philosophy, that to make these things work, you have to provide public rails, but private innovation. And this is essentially providing public rails, which the public sector will bring in, but allow private innovation to flourish. And this is how we're going to reach everybody in the world. Now, very important part of this is this system continues in the current world. So this is not going to happen overnight, right? So some players may come today, some may come tomorrow, some banks may come today, some asset managers may come tomorrow. They all have ways of converting into this. And every token is a full representation of that financial product. In other words, along with the actual bond or money or whatever it is, it has all the attributes that define that, all the metadata, all the, if it's a, if there's an insurance policy, a land title, those certification details. It's a self-contained, self-described token which can be sold very simply. And the reason why we use the word financial internet is because that's exactly how the internet works. The internet consists of a set of packets. Packets which have addresses which tell the packet where to go. And then the packet finds its way to the destination. What we have here are much more sophisticated financial packets or tokens which have all the attributes inside them, so they're very free to move around. And that's why it's like the internet, but for financial products. It's much more complex than data in internet, but it's the same principle. And we think this can be done. And these guys are, we call them token managers, will issue the tokens which the users will get access to. And they issue, manage, and synchronize the token with what's here. So when the token is, say, sold, then the new data comes into this. So essentially, the real world continues to have the latest status of these transactions, but the actual transactional efficiency is coming from the tokens. And as I said, the user opens an account in any ledger and gets issued these tokens. So, and I can keep any number of tokens in a ledger. And then we have that layer of applications which allow people to build all kinds of applications, and all that will be standardized so that new builders of applications can build on top. Something like how the internet has enabled so many private companies to build applications. Is that clear? Thank you. I mean, that's why I said you should keep this picture in your... So this is the whole thing. This describes how it works. It's an elegant solution with minimal invasive surgery. We're not trying to uproot the whole system. We're not trying to demolish the old system. We're taking an existing infrastructure of laws, regulations, and learnings we have about how society should be run. But inside that, we're inserting a high-performance transaction capability. And we're also separating out that we have will be an open infrastructure. Just like today when you use the internet, you use SMTP, you don't care about it, you know that it works. So this will be like that. It'll use the latest trends in cryptography, the latest trends in AI, all that will be there as open infrastructure. So what this is actually is nothing but a bunch of APIs. So there are programming interfaces where how do you unload and offload data from these token managers? A bunch of protocols for how two ledgers should talk to each other, which we call as the Unified Interledger Protocol, and a set of APIs which allow you to talk to all these third-party services. So it's really a bunch of programming interfaces and a bunch of data descriptions of what a token looks like. And you can have many tokens of many asset classes, and it could vary. I mean, one country's real estate token may look different from another country's, no big deal. So we're not trying to force anyone to follow this thing. But just like the internet, you have certain protocols that you follow. There'll be some protocols, but otherwise you have full flexibility in defining how these things work. And by layering like this, the society and the governance can be done through a layer of regulation institutions. The technology can keep innovating. So the technology can get better and better. The ledgers can get better. The ledgers can become faster. New ledgers may come. That's independent of the rules of business that you have at the higher level. And of course, users will have a lot of freedom to do things. So we think this can have an impact on wealth building, access to credit, insurance, new asset quality, new asset categories, cross-border payments, and so on. So all of them are now going to benefit from this infrastructure. And it allows market actors to get into new markets. Because if I want to now start blending in some other market, I can just take advantage of this. So actually, it will lead to market expansion even as it leads to better benefits for users. We believe that this can transform the lives of everybody on the planet. And you have already seen the document which has been put out. I hope you read it already. It really lays the framework. It's issued by Agustín and myself, BIS. But we have issued a second document, which is the technical architecture behind this. And that is also online. And I would welcome you to read that document if you're interested or want to be masochistic. But that describes how this technology will work, to show you that it's real and not just vaporware. And this is the QR code of that document. So I believe you can now take your phone and look at it, and the QR code picks it up. So if you want to take your phones and just take this. So this is the second document. Okay, the first document is the business document. The second document is the technical document. Together, this pair of documents essentially lay out the strategy. It's doable. It's doable in a few years. It requires political commitment, will, central bank governors taking it up, business actors taking it up, but absolutely doable, and it can be transformational. Thank you very much.
With that, and with the cross-cultural transmission of tech business visuals to economists, I'm grateful to Nandan. I'd like to ask the three governors to come up and join us for discussion. This takes us one step further into real life. Again, not to waste time with introductions, but just to say, going from near Nandan to near Agustín. Joachim Nagel is, of course, president of the Deutsche Bundesbank and has been since January 2022. He had a long career of public service, primarily at the Bundesbank, but also, as he mentioned, a brief stay working at the BIS as the deputy head of the banking department. And he also had experience with fintech, working at the Deutsche Börse for a while, or non-use of fintech, perhaps, but anyway. Next to him is my longtime friend Changyong Rhee, who is governor of the Bank of Korea since April 2022. Like everyone else in this list, except Nandan, someone who spent a career in public service and international public service, including as director of the Asian Pacific Department of the IMF, chief economist of the Asian Development Bank, and Sherpa for when Seoul was running the G20. What I would like to acknowledge and have this audience applaud is that since last November, Changyong has been appointed the chair of the Committee on the Global Financial System of the BIS, which has always been the committee. And he is the first Asian to serve in that position, which isn't why he's there, but it's a wonderful thing to see you in that role, Changyong. Thank you. And finally, but not least, Roberto Campos Neto, who's governor of the Central Bank of Brazil since February of 2019. He has real professional experience in the financial sector, including working with and leading Bozano Simonsen, Claritas, B3, and Santander's Treasury in the Americas. And obviously, what has been done in Brazil on fintech has been a leading case for all of us. So with that, you've heard from Agustín, you've heard from Nandan, you have your own experiences. Why don't we reverse order? Roberto, if you could start off, please.
How long?
Oh, let's see. It's now 3:45. You got 10 minutes.
Okay. I calculated right. Okay, so I'll try to tell you this, our story in 10 minutes. And it was amazing reading the paper. I haven't accessed the other document, and it will be good because I had some doubts on the infrastructure and how to relate them. And we are facing that, like a real problem in Brazil when we try to, connect the infrastructures. But telling the story of Brazil, I think the first question, and this was actually group study that we had, and then thinking about what would be the financial intermediation of the future. I think that was the first question. And we didn't know then what we do know now. But we were thinking about we needed to make the system more digital, to remove asymmetry of information, because asymmetric information is behind a lot of the costs that we have. And also we knew at the time that we needed to engage more people into a digital system so that it would be inclusive and sustainable. So the first thing that we thought is, okay, we kind of see what are the big blocks of the system. And our plan has 4 big blocks. One is the instant payment, which is PIX. The second one is how to internationalize this. The third one is open finance, a wide open finance, so that people can share data. And third is the tokenization part, which is our digital currency. So I'll try to connect the four big blocks. So the first thing was what we're seeing at the time was we're looking at people that were actually trading scores, gamers trading scores, and gamers trading and monetizing scores. And there were a lot of surveys on that at the time, and basically it was exactly what Agustín said now, which is very interesting, because what people are looking at, what they're after is a system that was fast, transparent, cheap, secure, and open. That was the 5 things that appear over and over. So we knew we had to go along those lines. So we were looking at what India was doing. So we talked a lot to people in India at the time. And in India, they had a system that was actually more aiming at solving government services problem and having a digital ID. And for us, the main problem, the most important thing is we wanted a system that was programmable. So we want to design a payment system that was programmable, that we could add new features, that you could add smart contracts on the top of it. And so PIIE came alive, and it was during the pandemic, so people had to work overnight. It was very difficult. So the people at the central bank worked really hard. And then PIIE came out. We didn't know to what extent the scalability of the PIIE would be important, and we didn't know if people actually would use it or not. The number of users was highly unknown. I remember first week of my conversation that we had, and we thought, okay, maybe in 6 months we're going to have 20 million users. And we had 20 million users in a couple of weeks. So that was really amazing. We just broke record, I think, a couple of days ago. We did 201 million transactions a day. That's more than 1 transaction per day per person that is bankerized. So that's very big. But then we look at PIIE, and we decided that as we are doing the project, you can add a lot of new features because it's programmable. So the idea is you start to insert the concept of programmable money on PIIE. So you can do now programmable payments. We're going to have automatic payments that's going to come live in November. We already connected PIIE to a lot of centers. So in Brazil, ultimately, you don't need ATM machines anymore because you can go to any store and you can withdraw money, because as long as a cash register is connected to PIIE, it can do banking functions. So basically, you eliminate the problem of 500 cities in Brazil that don't have ATMs, don't have bank branches. And so PIIE was a wide usage experience, and we are adding new features. But then there was a problem is, okay, but how about the cross-border? And I think we're still talking about cross-border. Agustín, I think, has done an amazing job on that. I think I won't go into step by step, but I think the technology part of the cross-border is mainly, I think, solved. We have a lot of governance issues on cross-border payments that we need to solve. You have Nexus, and you have some experiences that are working very well, and we need to connect the systems. So that was the second block. But the third block was the most important one, which is the open finance, and the most difficult, because this is the block where banks have, was the more difficult to negotiate with the banks. And basically what we're doing is a very wide open finance model. And I look at the chart that was above, and it was great to see the interactions. The question that I ask myself is, how can I make this system a system that has 2 things, portability and comparability in real time. So I want people to be able to compare and to change products in real time. So we had the rail. We already have a lot of people on the rail. So everybody's bankerized basically has a PIIE key. We try to internationalize, but then we insert the concept of open finance. And this is very difficult. It's much more difficult than PIIE to do, because the adoption is very slow. And the journey of the user needs to be very good. Otherwise, you stop using it. But today in Brazil, you don't need to have a bank account, an app for every bank account. You can go in your bank account, and you can import data from another bank and compare in a different app. So the idea here was that eventually we would have these marketplaces of finance. And I think a lot of people are working on what we call the super apps or the marketplace. So you wouldn't have an app for every bank in your cell. And this is very close. I'm talking like 1 year away, maybe less. So you would have an app or a channel, and the banks are going to compete for the channel, or even not even someone who is not in the financial system could build that. But then you'd allow all your data from the banks to be in that marketplace. And in that marketplace, you're going to be able to compare the data, compare the prices for the financial products, so you have immediate comparability and portability. And some people tell me, okay, this is very nice, but it's very far away from happening. And so I wanted to tell you some things that already happened, even though the open finance is in the beginning in Brazil. We already had 1 billion in credit that was object of portability thanks to open finance. 700 million in terms of increase in clients' limit thanks to the shared information in open finance. 6.4 million reais in savings for people who had the money just sitting in an account, and another bank sent a message and saying, if you transfer your money here, I will pay for your money. So a competition in real time. We had 1.4 million clients that were actually warned by a bank of some kind of migration in product, and half of them have adopted migration in products. So it's like you have equities sitting in a bank, and you pay a custody. The other bank will send you a message saying, if you move your equities to my bank, I will charge you less. So that is already happening, even though we don't have the ecosystem, which is the marketplace for finance. But I think we're going to have this very soon. I've seen some prototypes, and people are working on that. How relevant is that? We already had 74 billion calls of APIs, which means people asking for data from one point to the other, 74 billion. So this is really taking off, and I think this takes us to a different level because you're going to have competition online, financial inclusion, and you are going to be able to migrate from product to product in real time. But that was not going to be complete if I couldn't achieve the tokenization, because at the end, we think that the intermediation of the future will be more on an encryption format, okay? So we said, okay, now we have the PIIGS, internationalization is happening. We have the open finance that is already happening and is accelerating a lot, and we have a lot of deliverables this year. But then we need to make sure the system is a system that is tokenized. And then we spent a lot of time talking about CBDCs. And I don't think we were ever able to actually answer one fundamental question on CBDC, which is how can I do a CBDC that doesn't disintermediate the banks? So would I want a CBDC that changes the relationship between assets and liabilities inside the central bank? For us, the answer is no, we don't want that to happen. And it would be a long story to tell you all the things that happen when we have this, and that could create a lot of problems in our opinion. So we spent a lot of time saying, how can we get out of this? How can we get out of this? And then all of a sudden came the idea, no, we have a thing that it's much easier to do, which is, why don't we just tokenize deposits? So a bank blocks a deposit, issues a token on it, and because the central bank guarantees deposit, it guarantees the token. The same way we have a clear in the central bank for all the deposits, we're going to have a clear prime, which is deposits that are in form of tokens. That has a lot of benefits. But when we designed the system, it was not only about programmable money. It had 3 dimensions. And I will explain a little bit of the 3 here. And all of those were actually touched in the presentation, so I think it's very connected to what we're doing in Brazil. One dimension of improvement was what Agustín said. The banks still leave a lot in the legacy systems. And banks still look at the asset liability as an account base. So what happens if you change and you start looking at your assets and liabilities on a token base? Well, a bank becomes much more efficient. And we have pilots that shows us that in terms of risk management, in terms of asset management, funding, securitization, you can go on, and a bank really becomes more efficient. And one way to force the banks or to incentivize the banks to become tokenized was to say, okay, now you can take a deposit and you can make a token, and you're going to issue the digital money by tokenizing your deposit. And so the banks are actually funding most of the project in Brazil because they're very interested in being able to do that. So that's one dimension. The second dimension has to do with contracts and registration. So it's very expensive in Brazil to do contracts and registration. So if you buy a house, you have to go to a place where you have to register. Then if you want to take a mortgage, you have to go there, do another registration, and you pay over and over and over again. And it's not very transparent, the system. If you look at in US, you buy an apartment, you have to have a escrow account, you have to have a lawyer on one side, a lawyer on the other side, you have to have a lawyer that is an agent of the account. If you have a system that is a ledger, all this goes away. And the only attestability, the only testing, or the only certification process that you need to have is once you get inside the ledger, either for assets, financial assets, or physical assets. So we, in the law that establishes the system, there's going to be something saying every transaction that is done with the digital money has legal value. So all you need to have a registration, instead of paying a lot of fees, is to have a printer at home. So that is really, really, I think, what I think changes the level. So that's the second part of the problem. So first, you want to digitalize the banks, one dimension. You want to improve contracts and registration. And the third dimension is this programmability, where you interact with other systems.
Governor, we're going to need to wrap up.
So to close, we have these 4 blocks. So what can we enhance on the 4 blocks? 2 things. One is we still haven't been able to monetize information. So these market finances are connected to digital wallets in a way that everything that you do, you actually spit the data to a digital wallet. That digital wallet can be transformed into a token that interacts with the token that you have, so you can monetize your data. And the last block is we're thinking about how to insert artificial intelligence so that it can help the financial life of the people who don't really know how to use the financial products. I had a little bit more, but I think I've done my time.
Thank you. Since it's a group of your peers at the table, I have to try to keep it equal. Changyong, over to you.
Thank you, Adam, for inviting me to speak here today. Carstens and Nilekani's report offers a visionary approach to reshaping our finance system. And the Bank of Korea are closely aligned with their visions. And actually, what they are presenting today has been, earlier version has been introduced in various speech by, Agustín and Nandan. And if there is somebody who didn't understand what Nandan's present today, don't be disappointed. It took 6 months for me to get an idea what they are talking about with my staff. But after finding out what they are talking about, we decided to be an early adapter and announced 2 projects. One project is domestic CBDC pilot to implement unified ledger concept, focusing on wholesale CBDC and tokenized deposit. And second one is, as Carsten mentions, we are participating in the project Agora for international transactions. So rather than commenting on the paper, let me just highlight some of our experience so far in implementing their visions in our country. First question is that actually we initially started retail CBDC project. Actually, I'm interpreting their visions through the angle of CBDC. So initially, when we tried the retail CBDC project, one fundamental question, which is hard to answer, was introduced. That is why we need a CBDC in a country which already have well equipped with the advanced payment system. So for us, unlike the Brazil and India, financial inclusion doesn't really isn't one issue, and it's very hard to persuade the citizens that why we need to have a different financial structure in that sense. Even though I believe programmability and then also some efficiency gain in the back office is very important one, it's very hard to persuade the people. So we basically decide after reading their paper, decide to move our first pilot to the wholesale CBDC with tokenized deposit, because we believe that potential gain by tokenization is actually more manifest in improving the back office function infrastructure. And then also second reason is that actually this drive for having this kind of pilot, unlike other countries, was driven by private sectors. We have a very well advanced youngsters. They are actually very imaginative ideas. So there are a lot of tokens are trading already. You know, it's an idea, basic idea like transacting digital vouchers and digital carbon allowance and the transacting government bond in a mobile phone. That is already on the way. But you know, there are tokens that they sell Korean beef by tokens, and then there are NFT tokens for the voting right for the K-pop girl groups. So actually, they sell the NFT, and if you buy their NFT, you can vote whose member has to be sing in the center of the stage, and who has to have more revenue from their singing, some record something. So this is a kind of part of the, one example of the decentralized autonomous organization. And the many private company who is actually issuing these tokens ask us, we need a programmable central bank money to transact these tokens. We do not want to rely on the privately published stable coins because it has a bad reputation. So why the central bank, issued some tokenizable, central bank, digital central bank, so they can program together. And actually, they ask us to set up the digitalized Bank of Korea in their digital world. So they are quite well advanced, and we have a lot of pressure for them to match their advancement. But when we actually try this, our second project, introducing wholesale CBDC with tokenized asset, we immediately account for the regulation and legal issues that you mentioned, rather than technology problems. For example, I had some problem with convincing our financial regulatory body that tokenized deposit is a currency. But they believe the tokenized deposit is a deposit. So they have the whole regulatory power. So has to do these things. And this kind of difference also has an implication for who has the issue of regulatory jurisdiction and who can decide who participate in this, this unified ledger, and whether you allow the only regulated agencies, regulated companies, or whether you have to allow, what kind of scope that you have to allow in these ledgers. And at this moment, we have compromised with our regulators and have limited our CBDC, wholesale CBDC pilots to highly regulated financial institutions only. But I know that once we open these, ledgers, and as you mentioned, we call satellite ledgers, but in your opinion, ledgers for the unregulated and unregistered asset, then the issue comes who has to at least have should have a power for regulate them will be a very sore issue in the future. And then this issue is related with whether we have to allow, or whether it's feasible to allow privately issuance of private stable coins. Let me explain. If you read Nandan's paper, their paper, they show the spectrum of the tokenized asset depending on how strictly you can regulate it. And among those assets, still Bank of Korea and our regulatory body hasn't decided whether we have to allow privately unregistered and unregulated stablecoin issuance. What we are worrying about at this moment, there are tokens, unregulated, unregistered, and they are usually cleared through the credit card or some other fast payment instrument. But if tokenized deposits were introduced, probably issuer of these assets could have an incentive to significantly expand their stablecoin issuance by using wholesale CBDC-backed tokenized deposit as a collateral. But once they are issued and they are traded in public, DLT ledgers, it will be very hard to, follow them. And then what the regulators are worrying about most is that once we allow them, it leads to a misconception that these private stable coins are backed and endorsed by central banks. And basically, the main reason why we want to introduce tokenized deposit, which we believe is a stable coin issued by the regulated bank, is that we want this tokenized deposit serve as an effective alternative to privately issued stable coins for financial stability. And also, we have incentive to do so because we really want that our young investors focus on the issuance of innovative tokenized asset rather than being distracted by potential revenues of initial coin offering of some private stable coins. But it remains to be seen whether this objective is achievable without prohibiting the issuance of privately unregulated, unregistered stable coins, or whether even though we allow for satellite ledgers, whether we have to, prohibit them from the beginning. My last remark is we are very highly committed to participate in Project Agora and very grateful that we have this chance, collaboration with BIS, IIF, and 7th Central Bank. And we will definitely try to contribute our emerging market perspective to the development of this new cross-border infrastructure. And also our commercial bank are very much interested in this project because they thought that they have been lagging far behind fintech companies in this new technology platform. So they believe that this, this Agora project and its participation can be a good incentive for them to catch up and enhance their competitiveness. In Project Agora, I strongly suggest developing a common global regulatory framework for tokenized assets with a couple of key elements such as developing standardized classification criteria to categorize different tokenized assets, establishing standardized disclosure and reporting requirement for tokenized assets, ensuring investors to have access to transparent information about tokenized assets, and if this globally unified standard can be introduced in this project with Mr. Tim Adams for Agora project, I think this can be a good help for the tokenized asset issued in one jurisdiction could be traded across the borders. So in conclusion, I think some lessons can be only learned through experience. And as they say, the Bank of Korea is very happy to take all these steps to materialize Carstens Nilekani's vision. And we would hope that we can provide some lessons from our experience to the global society. Thank you.
Thank you very much, Governor. I see a way forward, and it involves Taylor Swift as well as K-pop. But President Nagel, please.
Thank you very much, Adam. I think this is not fair what you did to me to have now the pleasure after these two guys to speak. It's 4 p.m. afternoon.
You can tell us stories. It's fine.
And I do have a 12-page speech here. So, and I just said to myself, I will not do this speech. What I'm trying to do is to give you maybe the short version of what I would like to say. First of all, congratulations for your paper. I think excellent work. I heard so many frustrating things over the last 2-3 days. And maybe it's not my Neil Armstrong moment. It's maybe my Joachim Nagel moment, so I can fly back to Frankfurt and bring something positive. What should I do after speaking of my esteemed fintech governor colleagues? And the Bundesbank indeed is not famous to be so innovative. But let me try to give you a little bit my thoughts. And what can I do? I thought I begin with a vision. The former German Chancellor Helmut Schmidt, he once being asked about visions, and he said, when somebody has a vision, he should ask a medical doctor. And I guess he was right about so many things, but in that case, I guess he was not right. But what I learned is that a vision without execution is delusion. And what I learned from your presentation, I think execution seems to be not a delusion. It could become reality. And therefore, I welcome the idea of a Finternet. So now I give you really the short version of my speech. I give
we will post the full version online.
I do full version online. What I see here out of that idea, and this is definitely more than a vision, here a lot of opportunities can arise. Frictions can be reduced. You classified that this is a supercharger for financial services. DLT has the potential to streamline transaction by shortening the intermediary chains. I think this is something also what I got from your presentation. All can view in real time. That increases transparency while preserving privacy. Smart contracts reduce costs, save time, and enhance security by enabling automated business processes. In this context, CBDC should play a major role. Central bank money is the settlement asset with the highest quality. And I guess you all know that we in this euro system, we work on the digital euro. This is our lighthouse project for the next years. And some people are skeptical that we will not achieve this, but for sure we will achieve this. For me, this is a done deal. It is a challenging project. It will maybe last 4 or 5 years. I'm really proud that the Bundesbank will be part of that project, and we will serve here as one of the data warehouses for running then the digital euro.
But coming back to your idea, integrate final cross-border settlement in secure central bank money is essential. Use of integrated system can help to eliminate settlement risks. Smart contracts and DLT can ensure atomic settlement, allowing either both parts of a trade to be settled or none. Nevertheless, in addition to technological challenges, numerous political and risk-related hurdles must be overcome. And you addressed this. I think this is maybe the task what central banks could fulfill in such a complicated world. But it's, you know, this is often, it sounds easy, but often it's the most complicated part. Great potential for currency areas and participants that are not or only part, to a small extent here being connected to already relatively efficient markets. Another point, which are usually associated with potentially higher risks. Certainly, there are certain requirements for new participants and currencies that are necessary here to be implemented. And limited access of certain currency areas and financial market participants cannot simply be remedied or cannot only be remedied by changing underlying technology. And governance should be both clear and transparent, promote safety, efficiency, support stability, and be accepted by all. This will require coordinated action by a large number of players. This is definitely a challenge. However, let us not be discouraged by these challenges. Financial markets can make a decisive contribution to a more integrated world. Starting with development of regional solutions is, in my understanding, maybe the most practical approach. But let's not forget our existing systems. There are so many more areas for improvement. And so the Finternet is maybe one element, a very important one. And as I told you from the beginning, a vision could become reality. This was the short version. Thank you very much.
Brilliant. Thank you. Thank you, President Nagel. In all seriousness, the papers, the original paper, the QR code, the other paper, the formal statements, including President Nagel's in full, will be available right now on the Peterson Institute website, but also, of course, on the BIS and their individual institutional websites. Nandan or Agustín, any comments in reply to what's been said, or shall we take some questions from our distinguished audience? Could you press the button? Thank you.
I think it's very interesting that we're all thinking the same way. And I think the evolution of Brazil, Korea, and Germany in the euro, in a way, is compatible with the vision we presented. As Nandan said, our vision doesn't imply a quantum leap immediately. It has to take its time. We have to take advantage of what is there, and also to move and establish the regulatory and so on infrastructure is not easy. Therefore, I'm very, very pleased about the development and the evolution that our colleagues, the adventures they have entered into, because they really are trying to push the boundaries of their own financial systems. And I think their learnings, but also with what we constructed, I think it can cross-fertilize and bring a better product.
Thank you. Nanda?
No, I think the important thing is that different countries, different sectors, different industries can choose to adopt this at their own pace. I mean, nobody's saying this is the only way of doing things, but it could be that the banking regulator in one country or the market regulator in another country can take it up, and is designed to be very flexible in its adoption. But I would be remiss in not mentioning my two colleagues here, Dr. Pramod Verma. Pramod, can you stand up? And Siddharth Shetty. I have basically done the presentation, but they've done the work. So I think Pramod is the architect of everything in India, and he's one of the best public system designer in the world today. And Siddharth is a brilliant young protege. So I think they have done all the hard work, and I want to acknowledge that.
Very good. We're honored to have you with us. Let me turn to our distinguished in-person audience for on-the-record questions. I'll group them two at a time. Jessica up front has a traveling mic. In back, there is a standing mic. Either wave for the traveling mic or go to the standing mic. And please identify yourself when asking a question. Who would like to be first? Wow. Okay. If you could go to the back mic, the person who raised their hand up there. Yep.
Hi, Martin Trozempa, Peterson Institute. As an author of a book on China's fintech system, I actually really have a lot of respect for what India and Brazil in particular have done without CBDC. I'm really excited about this vision. And what I wonder about it is how will pricing work, and how might this affect the global system for transactions, which currently revolves a lot around the US dollar and concentrates a lot of liquidity and pricing around USD. I can imagine that if you have multiple unified ledgers of different types of assets, that might fragment liquidity across different ledgers and make it more difficult. And many of the systems that you've tried so far in cross-border payments have not really included pricing mechanisms. So how would that work? Thank you.
Thank you. And the second question?
Yes, this is a very exciting...
Identify yourself, please.
Sorry, Patrick Honohan, Peterson Institute. This is a very exciting and promising development for the world at large. But my question, and it's a serious one, is for the financial system, the profitability, the size, the scale, is this a threat to the financial system? Will it be disintermediated largely in terms of the volume of activity? Of course, the services will increase, but the volume of activity may decline.
Just to be clear, I would rather recognize people from outside the Peterson Institute. So if you're willing to be brave, you will get to ask a question. My people are fearless. But anyway, would any of you like to respond to either Martin Trozempa on liquidity issues cross-border, or Patrick Honohan on fears of disintermediation?
Well, I do briefly both. I mean, the idea here is that with the different players that Nandan put at the top of his chart, famous chart, you can organize the market. The idea here is to invite market makers that exist today. I mean, here the idea is to really generate the tokenized market based on, and what is important is to bring the concept of unified ledger, but the market should be organized in a natural way based on the role of the intermediaries, you know. I mean, here the idea is to bring them on board onto this vision, you know. The idea is not to say we will displace you, is how can we create, the question would be how can we do this market in a way that integrates the easy access, that integrates the ledgers, and that depends on tokens where all the information, the regulation, the compliance is embedded, you know. And the same idea it has the same type of answer goes to what Patrick mentioned. I mean, here, for example, you see that a key arm for the payments, we are not inventing here again the hot water. I mean, we want it to be based on commercial bank money and with settlement in the central bank. So we are not proposing create a new currency. What we want is to bring on board the banking system. One of the big attributions of the banking system is provide the payment systems. And then once you have that access and you start developing applications, but based on these principles, you can start building up the value added, and that's the value added that we are expecting. It just will be in this new type of platform. Of course, the infrastructure, the market infrastructure and so on will need to be created. But the idea is to invite the players to to take, let's say, the philosophy of this vision and replicate many of the operations that exist today in a more seamless and efficient way, and also to open the opportunity for new type of transactions to be created.
Does anyone else want to come in? So Roberto.
Okay. So on the question of the cross-border, today most of the payment systems are not DLTs. They are centralized systems, most of them that exist today. And you can connect them pretty easily, and there are technological solutions for that. When you have DLT and you want to connect them to centralized systems, some issues arise depending on the DLT. So like if you're using like a hyperledger bezel and you want to connect to a centralized system of one entry point, then there's some things that show up as a problem, but most of it has been solved. The main problem is, I think, 3 dimensions on the governance. One is the AML, so all the things on money laundering. So you need, the system is instantaneous. You're going to be doing billions of transactions. You're not going to be able to identify IML things and characteristics that are preset if you were to program the transfer before. So the first one relates to the AML. The second one relates to places where you need to know the origin of the transaction to allow that to happen. So in some places, the tax system is connected to whether you're local, you're not, whether you're a company or a citizen. So you have to have some kind of taxonomy before connecting the dots, because otherwise the system won't be able to, and you cannot lock one transaction. If you do that, you start having a lot of backlogging problem. And the last point is what you mentioned. What is the implications for liquidity? So if you have the systems connected with full access and no gates, would the country be comfortable if its citizen decides one day to remove the money from a bank in Brazil, for example, and open an account in US and buy a CD from a bank in the US and transfer all the money? What if everybody wants to do that at the same time? So those are the things that I think still need to be solved. I think this is more of a governance issue than a technology issue. I think the technology issue is doing pretty well.
Okay. I'd like to, if there are brave souls, get 2 more questions in before we close. Really?
Just very shortly what Patrick said, because this is a very important issue you raised. Because from a regulator point of view, I would like to have the Finternet tomorrow. Because in these days, I have the feeling we are really often on a daily basis behind the curve. The complexity of the financial system, there's a huge opaqueness that we see from a regulator point of view. If I understood your idea correctly, and you put that on your slide where you said, okay, this is the most important slide, you bring all the important players together. And there is, let me say, this clarity you need also from a regulator point of view. So this is my short understanding. That is really something that I see that can handle the complexity, the volumes, and the different players.
I'm not sure having all the information is equivalent to being able to handle it, though. You might want to be a little careful about that. Yeah, Nandan.
I just want to talk about, I think there was a question on competition and what does it mean for existing profit pools and all that. I think what we have seen is we are essentially suggesting that we move the financial system from low volume, high value transactions to high volume, low value transactions. In other words, expand the market. To give an example, and I think the same thing must have happened in Brazil, we had 30 million credit card users in India. We have 500 million UPI users in India. So you expand the market dramatically, and that not only drives economic activity, it brings more people and it makes more profit, but you make less profit per transaction, but you have a hell of a lot more transactions. And I think you ought to think of this as a market expanding thing. It'll help the banks to expand markets. The capital markets in the US are already extremely efficient. It'll further scale them up. It'll allow, because of the tokenization of different assets, you can mix and match and create products that you could not have done before. And it'll allow illiquid private markets to become more efficient. So I think it has huge benefits.
All right. The lady right here, please. Jessica. So this one here, and then the woman over there, please. No one went up to the back mic, so those will be the last 2.
Sure. I'm Kay Turner from the Financial Crimes Enforcement Network in the Department of Treasury. Just wondered if you could speak to the complexity of this system and the uneven ability of financial institutions, depending on their size, to deal with some of that complexity. The reason I ask is that at FinCEN, we ended up doing a tech sprint with the FDIC, and it was all around solutions to measure the effectiveness of solutions. In that case, it was onboarding digital identity proof. And one of the big takeaways is that smaller and medium-sized organizations had challenges selecting which provider to buy because they had that challenge to figure out apples and oranges, what was the right one to buy. So I'm thinking about the complexity of this new system or the tokenized system that you layer it in. How do you bring all the financial institutions along?
Okay, thank you. If we could transfer the mic over there for the last question, please.
I'm Ratna Sahai, former IMF, now at CGD and NCAR. One is a question for Nandan, just to understand that famous graph. I think it was very reassuring for you to say that you don't have to dismantle everything. You superimpose this super machine at the center, and people can go at different paces. Now, my question is, when you do get to the vision and everybody's reached that level, does the periphery kind of disappear? Are some players no longer needed? I guess you still need the super app for the end users. I can't see that going away. So that's a question. And the second question is, I want to also ask, so once you've achieved, again, this vision, what could go wrong? If there's a global power outage, I don't know, cyber risks, cyber fraud.
So obviously all that has to be considered. I think and the end game is very far away, but finally the institutions will continue, but they may do all transactions on the tokenized network and not in the traditional method. The service providers will continue to provide services at a much higher scale. And there'll be a whole new set of consumer-facing applications that we don't even exist today, which will create a thriving market. So I think that's very much that. But remember that this system, every time there's a transaction of a token, the original asset manager or bank is synchronized. So actually, everything in real time is synchronized outside this box. So even if the box goes, nothing has changed because the real world already is recording all this stuff. So actually, it's a very easy way of creating a sort of system of speed and then making sure it gets back to the original databases.
Okay, anyone else? Yeah, Changyong, then Roberto. Changyong.
No, I wonder if Anand, do you want to answer or give your comment on the question of the small players?
Yeah. So I think if you want to get into how to implement this, what is the technology involved here? It's a set of programming interfaces, a set of schema design principles. How do you design a schema for a token? How do you describe a token, etc.? And maybe one or two reference implementations of how this will work in the real world. So all this will be built as open source or specifications from some kind of a body we have to think about, which will be the owner of the specifications. So it will reduce the onboarding effort and cost even for small companies. Because it's the way how you do it. We want to make it actually highly accessible around the world to everybody.
Changyong.
I just wanted to answer the question, what could go wrong? And these are exactly the questions that I received when I proposed this thing to our regulator. And so I thought about it. And then for the regulated and registered asset, I think there is also benefit of having this system. For example, like a real estate transaction in Korea, in order to transfer the title, all these things, you have to go through many physical institutions, and there's a time gap for paying the money versus get the title back. And there can be a lot of fraud on this thing. But by tokenizing these things, do all the transaction simultaneously real time, there can be what can go wrong can be reduced. So for the registered and the regulated assets, I'm a little bit positive on that. But for the unregulated, registered asset, I don't know the answer. That is why I say that some lessons can only be learned through the experiment, and that's what we are doing.
Okay, does anyone else want to come in on the small banks or the what can go wrong?
I can comment on what can go wrong. I think a lot of things can go wrong, but not doing anything also can go wrong. And the way technology is advancing and people are finding their own solutions for payment, I guess by not being there, you have a higher risk of going wrong than being there, in my opinion. But if you ask me what keeps me up at night, I think there is one thing that we still don't have the domain, which is we are assuming that we're having tokens. And the token is nothing but an encryption that is put around some kind of asset. And these encryptions today, I'm going to oversimplify a lot here, but the encryption today, the safety of the encryption is based on some derivation of a very old algorithm, the Shor algorithm, which is a combination of prime numbers, and you can sophisticate and elaborate on that, but it's based on calculus that is very difficult to do. So today, the safety is based on calculus that is very difficult to do. And now we are approaching an era in which you're going to have quantum computers that can do calculus in a much more efficient way, and we don't know to what extent that will escalate, and we don't know what that does to the encryptions that we have today.
Great, thank you. Joachim?
Maybe just to come back to the question regarding maybe smaller banks and what does that mean for, let me say, maybe financial, maybe this access to that technology. And so I believe that the technology is there, then we should take advantage of this technology. And what I took from your presentation and what I learned from the paper, I think one advantage is that there's an easy access to this platform and how to make use of it. And so I believe even for small banks, for not so sophisticated financial market participants, I think this is a big advantage. And nevertheless, I think at the end, it is all about financial inclusion. And this is what you learn from your experience in India, that this is possible, even for those that are not even have maybe a mobile phone. And so it is something where I see beyond what we see from the complexity from the markets, that this is really one of the positive elements that I take from your Finternet idea.
I'm glad to have President Nagel end on another positive visionary. No joking. I mean, that's great. That's what this is about in the end. So with that, please join me in thanking this unique assemblage of leaders. And particular thanks to Agustín Carstens, General Manager of the Bank for International Settlements, who is the one person who could convene this group. So thank you for that as well.
Thank you.
Thank you. No.